Good morning, everyone. I'm Steve Elliott, and I'm the Vice Chair for the Chamber's Economic Development Department and Managing Director at Stanford University. On behalf of the on behalf of the Redwood City San Mateo County Chamber of Commerce, I'll get to that. There's a reason I said that. And Sam Seed, I'd like to welcome everyone here this morning to the Economic Outlook. And thanks also to the collaboration of Roseanne Faust and Amy Buckmaster, our two presidents and CEOs. We are fortunate this morning to be presenting an exciting program for you. We have senior economist for Wells Capital Management, Gary Schlossberg, who always comes with a wealth of information, and he'll be setting the economic stage for a discussion to follow, facilitated by Sam Seed's president and CEO, Roseanne Faust, with two panelists, chief financial officers, Jim Burns of Silver Spring Networks, and Kevin Beals with Nearby. Unfortunately, Joe Nemeth, Chief Financial Officer of Turn, was called out of the area and cannot be with us today, so we're sorry about that. But before we start, and this is where the Stanford part comes in. Before we start, we'd like to thank our major sponsors for this event. Stanford University, Cargill, Kilroy Realty, San Mateo Credit Union, San Francisco International Airport, Hartnett Smith, Pateco, Attorneys at Law, Sequoia Hospital, and Recology. So let's give them a round of applause, please. They have truly helped to make this program possible, as well as our media sponsor, the San Francisco Business Times. And we also want to thank Joe Gamina and Oracle for making this magnificent facility available to us. So, a round of applause. Thank you. And this next part baffles me, but I'm going to say it anyways. We just need to alert everyone that during the program, Holly McFarland of the Chamber, our events coordinator, will be live tweeting using the hashtag EO14. If you know what that means, great. If you don't, talk to Amy and Holly. But it sounds exciting and viral and social and all that stuff. So again, thanks for coming. We're really excited that you joined us. We have a great house full. This is wonderful. It must mean things are going well, but Gary's more of an expertise on that. So I'd like to introduce Gary Schlossberg, who has attended this event before. You all have probably heard him. Although he is a senior economist for Wells Capital Management, he can also be heard on many Bay Area broadcast stations where he's often asked for his advice. At Wells for 29 years, he's responsible for assessing the economic environment and providing input to the equity and fixed income portfolio management teams. Gary received his master's degree from Pennsylvania State University and his bachelor's degree from the City University of New York. So thank you for coming, Gary.
Thanks, Steve. Thank you, Steve. It's great to be back here. It doesn't seem like a year. What I'd like to do today is to just give you some thoughts, our thinking on the outlook for the economy, the financial market, some comments on California. I'll be looking to Amy to give me a high sign about 10 minutes, 15 minutes before my time is up, and hopefully we can open it up again to questions. I've got to warn you, 2 points. It is a large audience, like I said last year. No hardballs, only softballs, please, don't embarrass me. And secondly, try to avoid bringing up some of my comments about the outlook a year ago. I know some of you have jotted down some of the points I made, and please don't remind me of some of the errors I made. We do tend to zig when the economy zags, and it's just one of the hazards of the profession. It has been an interesting year. I say that every year, but in many ways it really truly has been. Looking back over the last 12 months, really more interesting, I think, more upbeat in the financial markets. The stock market clearly has just soared this year, propelled by the very aggressive stimulus by the Federal Reserve, the quantitative easing we've seen, but really validated to some extent by the growth in profits. In a pretty difficult environment, businesses have continued to generate modest growth in corporate earnings, which isn't all that bad at this late stage of an economic cycle, all the more remarkable because revenue growth hasn't been all that strong. That's good and bad, but the focus has been on cost-driven gains in corporate profits. Our view, in a word, is that the market is not wildly overvalued. There are elements of froth in the market, in parts of the stock market, in parts of the financial market. We can get into that a little bit later. But in terms of the fundamentals, suffice it to say that while the market is certainly fully valued, we don't think it's at the edge of a cliff by any means. Certainly vulnerable to a shock next year if that develops, but on reasonably firm ground, certainly in better shape than it was, we think, than it was at the end of the dot-com boom back in 1999 and 2000. The bond market certainly more uneven, just given the ebb and flow of interest rates. The market did soar through the spring, and then we had the backup in interest rates, and that sent the bond market tumbling a bit through much of this year. It is down a bit for 2013. The economy, much like the previous few years, started off on an upbeat note. We seem to be fairly resilient to the fiscal cliff. The fiscal cliff finally overtook the economy to some extent, notably the end to the payroll tax cuts. Some of the tax increases weighing on the economy slowed things up around the spring of the year. For the fifth straight year, the economy went through something of a soft patch, due in part to the aftershocks of that fiscal cliff agreement, tax increases, government spending cuts, some of it due to the backup in interest rates. Interest rates took off after the Federal Reserve hinted that it would be winding down quantitative easing. That certainly created a headwind. And those trade-oriented firms and U.S. foreign trade in general certainly suffered to some extent, even as Europe was slowly healing and bottoming out from a very difficult twofold recession over the past couple of years. China began to show signs of slowing, excuse me, during the middle quarters of 2013. The economy more recently has regained momentum, much as it has over the previous 4 years, very late in the year. Signs of a pickup in economic activity validated to some extent by this morning's employment report, very encouraging. Some of the strength overstated by the end of the government shutdown in October. These numbers were for November. But if you haven't heard, the non-farm payrolls in the U.S. came in a bit stronger than expected, up around 203,000. The market was looking for 185,000. The unemployment rate dropping to its lowest reading since November of 2008. And the overall tone to the report was encouraging. When I left my office, the market had rebounded back up to a one-week high, but really supported by a couple of areas of strength, which I'll get into in a moment, because I think they are important for 2014. California has been neck and neck with the U.S., at times outperforming, at times falling back. Our measure of performance, as I mentioned last year, the employment data. It's not the best measure of economic activity. It has the advantage, however, of being very up to date. We have data through October. We'll be getting the November data probably in another 2 or 3 weeks. Very up to date, very detailed by region and by industry. And what it's telling us is at the moment, California has fallen a bit behind the national average in year-over-year job growth. Behind that, or underneath that, underlying that is continued strength in the more export-oriented industries. And as I may have mentioned a year ago, export industries in California or anywhere else to us are defined. Actually, I'm taking a page out of an idea that Steve Levy developed from the Center for the Continuing Study of the California Economy, defining export industries as those industries deriving the bulk of their revenues from outside the local economy and often acting as an engine propelling the economy or tipping it back into a recession. The last recession, something of an exception. A lot of that was driven by a domestic industry, housing. It was nationwide, but it certainly weighed on the local economy and pulled things down along with it, including commercial real estate. But generally speaking, our export industries have been an area of strength. What are our export industries? Well, technology is the most visible and probably the most powerful driver of economic growth that we've had so far this year, over the last couple of years. In addition to that, tourism, the hospitality industry, very powerful this year. The source of employment, a major driver. In terms of the effect on the economy, not quite as powerful because many of the jobs are lower paying, but certainly providing an underpinning. The motion picture industry, agribusiness. These are the kinds of industries that are drawing strength from the outside. They've also been hurt at times by the slowing in overseas economic activity, but have provided that support along with the recovery in California's housing market. And that's provided a good underpinning, but the shift to more sustainable growth in some of the stronger areas, particularly here in the Bay Area, along the west side of the Bay, down in Southern California and Orange County and the like, shift toward more sustainable growth, ongoing weakness in other areas. Contra Costa Alameda being one, the inland areas being another, have weighed on economic growth and pulled California a bit behind the national average. Where do we see things going in 2014? Well, I said the same thing last year. I'll just have to highlight some of the risks out there a little more than I did last year. Risks, by the way, if I didn't mention it last year, are a euphemism for excuses we have when our forecast goes wrong. So I want to make sure I get the risks in. But fundamentally, the economy is poised for a moderate growth recovery, a continuation of what we've seen so far. I'll get into the risks in a moment. But certainly the numbers haven't been uniformly strong. The early returns for Christmas sales, very disturbing. The fact that online and traditional brick and mortar sales are actually down from a year ago for the first time since 2009. That against other data that seem to indicate that the economy is holding up quite well. Certainly the employment numbers today, we look at purchasing manager reports for manufacturing, non-manufacturing activity. They're suggesting moderate to moderately strong growth. I might add that it's being led by the manufacturing sector, which is very encouraging as well. Manufacturing tends to be more trade-oriented, more cyclically sensitive. We're seeing the strength there. Housing beginning to perk up a bit again after showing signs of fatigue in that recovery during the middle quarters of the year due to higher mortgage rates. All in all, we think that the economy already has been regaining momentum, notwithstanding what we're seeing with retail sales. Jury's still out. We still have the rest of the selling season to go, but clearly that's a yellow flag out there. But looking at the supports for the economy that help drive economic growth, they have been, I wouldn't say uniformly positive, but there have been an array of strengths that are providing support for moderately good economic growth. What are they? Well, for one thing, the rally in the stock market, the housing recovery, the double-digit increases in home values are propelling household wealth. Inflation-adjusted household wealth per household is rising in the upper single digits, very strong growth. I might add the corollary is that that is helping to drive spending by upper income families. They tend to have a disproportionate share of the wealth, not surprisingly. They tend to be more sensitive to changes in asset values. And those asset values rising at a double-digit rate have certainly provided a tailwind for the economy. Secondly, while fuel prices have been bouncing along the bottom of late, they picked up and then they ticked down again in the latest week. They are quite low by the standards of the recent past. Probably the lowest we've seen since, I believe, early this year, or depending on where they are today, perhaps at a 2 or 3 year low. The point is that because they're fairly low by the standards of the recent past, they provide something of a tax cut, in effect freeing up income in the household budget that doesn't have to be spent on fuel, can be spent on other goods and services. On top of that, we have income growth, employment growth picking up speed, income growth still fairly moderate, but it is beginning to accelerate, that providing more of a broad-based tailwind for spending, not only by upper income families, but across the board. On top of that, foreign trade is beginning to improve. The US dollar has strengthened a bit, our competitive position has eroded, but more important than that, at least for now, is the fact that the global economy has begun to pick up a bit. China, the worst seems to be past, at least for now. It is a risk in the outlook, but at least for now, China's economic activity seems to have perked up a little bit. Europe is less of a drag. We're starting to see foreign trade in general pick up, and it's showing in our exports. Despite the fact that the dollar is fairly strong, that will weigh on our exports down the road, but the more immediate effect is stronger demand abroad, and that is benefiting our trade position. One wild card in the outlook, which could turn out to be on the upside, deferred spending by businesses. There's been so much uncertainty about the policy outlook, healthcare reform, financial services reform, the environment, the tax outlook, what government will do with spending, the outlook for the sequester, related cuts in spending. Businesses seem to be holding back on hiring early this year, and more recently, they seem to be holding back on investment spending. Typically, hiring and investment spending are more or less positively correlated with overall economic activity. And what we've been seeing lately is economic activity continuing to pick up, as I said. More recently, hiring has finally begun to pick up as well. Businesses can hold back only so long. They can stretch the work week, they can increase overtime, but we're starting to see hiring pick up. But if you look at investment spending, equipment spending, it actually has rolled over. It still hasn't begun to pick up speed. Our feeling is that once we get by some of the deadlines early next year, and I'll get into those in a moment, when businesses, if and when businesses get a little more clarity, we would expect to see stronger investment spending, a lot of it more in the high-tech area. Businesses are still under a lot of competition. The focus is on cost control. Operating rates are still fairly low by historic standards, so the need to really build on purchases of heavy machinery, except for replacement, is just simply not there. The focus of investment should be more in the high-tech area going forward, and that could add to economic growth as well. What are the risks in the outlook? Well, as I said, there are some deadlines. Mid-January, the next round of the government sequester kicks in, another round of spending cuts. The end of the continuing resolution to keep the government funded, basically extrapolating continuing spending at fiscal year 2013 levels, has been extended to mid-January. That deadline is mid-January as well. No coincidence there, it just adds to the pressure on politicians. And then by early February, of course, we have that new debt ceiling limit that over time, with about a 1 or 2 month lag after all the accounting gimmicks are played out, could impinge on our ability to repay debt. Our feeling is that we'll get by those deadlines. I don't mean to sound too optimistic, overly optimistic, but the fact is that it's in no one's political interest to shut the government down. I know the Tea Party Republicans pushed the government to the edge. We did have the shutdown last time around, but there is a new committee out there chaired by Paul Ryan on the House side and Senator Murray on the Senate side. They seem to be moving toward a mini compromise, enough so that both sides will declare victory, and hopefully we'll be able to get by those deadlines, cutting off government spending. The package is supposed to tone down sequestration, if not eliminate it, in favor of other more rational spending cuts, and hopefully enable us to circumvent that debt ceiling deadline. But clearly, that will be an 11th hour process, an 11th hour event. Some uncertainty heading into the new year, and the economy could stumble at least temporarily on that. Second area of uncertainty is with China. China's credit situation is tightening once again. Interest rates are moving up. China's trying to strike a balance between cooling things off in the real estate area, trying to make some structural changes, relying less on exports and investment spending, the overinvestment that we've seen, more on consumer spending. And then when growth begins to drop back a bit because of the social and political pressures that develop, they revert back to the tried and true investment and export-led growth. So that's certainly a risk in the outlook as well. And another one, as a segue to interest rates, is the backup in interest rates, how well the economy will be able to handle that. We don't think the Federal Reserve will move to wind down quantitative easing at the next meeting in mid-December. We think it's more likely the event will take place early next year, either at the January 29th, 30th FOMC or sometime in mid-March, the 19th and 20th of March. The economy does seem to be coming back. It's arguable whether it's coming back strongly enough. The new chairman coming in all likelihood, if she's confirmed as it's expected, Janet Yellen does tend to be a bit more dovish than Fed Chairman Bernanke. We do have the same policy uncertainties that helped encourage the Fed to delay a wind down back in the fall. Inflation continues to come down. Some concern about deflation, prices actually dropping. All that to say that I hate to make forecasts like this so soon before the event. 10-year forecasts are a lot better. I'll let you know when I'm right, and you'll probably forget by then if I'm wrong. But I would say that while the odds have gone up that something will happen from the Fed, more likely the Fed will defer until early next year. But when it does happen, and in the run-up to that, our feeling is that interest rates will begin to move up, not as abruptly as they did back in the summer, but we think they'll move up ahead of that announcement and after the announcement as the Fed begins to pull back on the direct purchases of government securities, which drove prices up and yields down. Our view on interest rates, rates rising modestly. We think, as I said last year, I think I said that they'd probably start rising late this year. We're just rolling the forecast back one more year, but basically long rates lead. Toward the end of next year, early 2015, I feel more comfortable with a forecast like that, based on the assumption that the Federal Reserve doesn't actually tighten monetary policy and raise short-term interest rates until well into 2015, let's say the third quarter. Typically, what you see are shorter intermediate rates in that 1 to 5 year area begin to take over leadership of the rate increases in the 4 to 6 months before the Fed makes its move. We think that's what will happen in late 2014 through the middle part of 2015, and then the Federal Reserve, if the economy continues to perform as we think it will begin to raise short-term rates. But that near zero short-term interest rate environment we think will be in place for another year to 18 months. Economy continues to operate in a very narrow channel. It continues to heal from the meltdown in the financial markets 5 years ago. We have something of a mismatch in the labor markets. We think we see it right here in California, which is something of an issue, a dichotomy developing between the high growth, more skilled areas along the coast and the more traditional industries in the Central Valley, weighing on the state's overall economic performance. We think that continues to be an issue down the road. Foreign trade, given the inability to continue moving forward on free trade, could be more of a restraint going forward, particularly as the dollar moves up. One other point I would make, though, certainly on the financial side, we think we'll continue to operate, and I'll make this my closing remark. We think will continue to operate in a low inflation, low interest rate environment. Those rates will move up, inflation will move up gradually. We don't look for deflation, which is a real concern now. We think inflation will firm up a bit, but we're not talking about an acceleration of inflation, anything like we had in the late 70s, early 80s, or even before sometime thereafter in the 1980s. In that kind of environment, as I mentioned a year ago, it encourages asset price volatility, asset price inflation. Investors looking for a higher return, either out of necessity, like pension funds and insurance companies, or simply looking for that higher return, you could say greed, whatever it is, looking for the higher return in riskier assets. Levering, finding leverage more easy to arrange given the low short-term interest rates, much as we've seen. That means the markets become more volatile, piling in, moving out by financial investors, depending on conditions in the market. And we see that kind of volatility, the risk of a boom-bust cycle in various commodities continuing in the foreseeable future. I might add, dovetailing with that is a growing issue of income inequality and how the government will deal with that. And if wealth is a main driver, as we've seen over the past couple of years in the economic cycle, and we continue to see this dichotomy between the wealthier individuals and the lower and middle income strata within the economy, the risk is that we start developing policies to try to force an equalization of income to the detriment of economic growth. Kind of a long-term issue that I would just keep out in front of us. It's sort of off the radar screen now, but something that could become more apparent down the road. For California, the areas along the coast, the skilled areas, the benefits that we've had, the entrepreneurial talent, access to venture capital, and the like, we think will continue to be an important driver of economic growth. But the growth in California, typically it spills over to the Central Valley as growth continues. We think may be slower to develop, and we could see more of a dichotomy developing there out over the next 3 or 4 years. Do I have any time left for questions, or did I save myself by going right up to the end? Okay. All right. Any questions, comments about anything I had mentioned? Yes.
Thank you once again for being here.
Thank you.
Your comments on income inequality, you seem to say that one of the problems with that is that the government might enact policies to equalize the income.
We're seeing a little of that already on the income side.
But if the government doesn't do that, and we continue to have growing income inequality over a prolonged period of time, what do you see the consequences to the economy of that? Without the government doing anything to equalize it, but are there negative consequences you see to the economy ultimately with that, or you think it doesn't matter?
Well, in pure economic terms, I think that in theory at least, and in the past, we've seen strength in upper income families. In fact, they're often a catalyst for economic growth coming out of a recession. They typically are in better financial shape. You see the stock market rallying. That tends to benefit upper income families. I'll just throw out a number. The top 10% of families by income early in a recovery typically account for 25 to 30% of the growth in consumer spending. In this cycle, because the middle and lower middle income families were hit so hard, upper income families had, and at times I think continue to, I haven't seen the more recent data, account for something like 40-45% of the growth in consumer spending. In pure economic terms, I would say they're an important driver. Eventually you get a trickle down, you get the spillover, you get the broadening, depending on the policies in place. I mean, a lot of it depends on the environment, how growth is overseas, our competitive position in manufacturing, which can provide fewer, but still blue-collar, higher-paying jobs to help equalize. Growth probably isn't as strong because you don't have the rising tide lifting all ships and then more of a ripple effect. To me, the bigger problem is political and social. And when I talk about income inequality, I'm not only talking about a snapshot, skewed distribution. What we're seeing as well, according to studies, is the mobility. People moving across various cohorts, moving from middle to upper, just the mobility within income groups breaking down as well, and that's equally disturbing. So from a political and social standpoint, I think down the road, it creates problems. It fosters an environment where you encourage policies to try to force a more equal income distribution. And based on the work I've seen, that works to the detriment of economic growth. So directly, probably not as much of an impact as it has indirectly through its effects on economic policy. And the big risk down the road is, as you try to close budget deficits and you focus on upper income families, you move away from simple tax increases on incomes, and the income tax brackets have become increasingly progressive, but then you begin to focus on wealth itself. We've seen a little of that funding affordable care in part with a tax on passive income, and that is an opening. The other area we've seen is just simply haircuts on exemptions and deductions. Could see more of that, but that whole area of wealth, the opportunity there, the potential is great, and equally great is the potential to blunt economic growth as you create disincentives for innovation and trying to generate that wealth. So it's sort of a long-term issue. It's not something I think is a clear and present danger, but it's something to be mindful of given the fact that our income has become more fossilized and more skewed. Try to keep my answers shorter. That was almost as long as my talk. Yes? Yeah, I'll repeat the question.
You talked early in your talk about government regulation and the impact on any potential growth. Well, the banking industry is looking at Basel III and capitalization, recapitalization, or increased capitalization, and the other effects. Do you have a comment on how that might affect future growth related to the impact that banks might have?
Well, in terms of financial services, and I'll try to tiptoe around that because I do work for a bank, but there is enough uncertainty about capital rules themselves. The regulations are tighter. We do have, for better or for worse, we have a new consumer watchdog that focuses on lending terms and conforming. We're simply more regulated now, for better or for worse, than we were before the meltdown. And this isn't unusual. If you look back during the Great Crash in the 1930s, a lot of the legislation, some ill-conceived, some constructive, was developed in 1934 and the mid-1930s to deal with a problem that developed earlier on. The question is, I think, are some of these new regulations, which clearly are creating uncertainty now, but really restricting banks, forcing greater scrutiny in certain types of lending, whether or not they're really dealing with the nature of the problem that developed and the risk of another meltdown in the financial markets. And I think there is a lot of debate about that, but you know, my take is that the meltdown itself was really a team effort. You know, banks made mistakes in the housing industry, lending against the value of the asset rather than the income of the borrower. There was certainly an incentive to do that, but ultimately that ends badly. Households, out of greed or just trying to maximize their return, but at the top of the pyramid, I see the government laying out the environment that encouraged that kind of speculation. Clearly there was a certain amount of fraud, there were violations of the law, but I'm glad Steve's on his way up because I'm getting in over my head here. But I do think that certainly, back to your point, that the restrictions are one of several reasons why lending growth has been so weak in this economic cycle. There are reasons that are equally important, but if you look at lending growth, we're still below where we were in terms of loans on the books of banks, where we were back at the beginning of this economic recovery. And normally you see lending growth 25, 30% in real terms, adjusted for inflation, which is really the way to compare it. And the outgrowth of that, the corollary is we're seeing this pressure to develop a shadow banking industry, which becomes less regulated, more volatile, and can be a source of instability down the road. Am I finished? I think I'm done. Anyway, thank you very much. Great holiday season to all of you. Hopefully next year. Bye-bye. Thanks, Steve.
Thank you, Gary. Holly, how's the tweeting going? Good. Up during the what was it? Hashtag EO14. Well, I just signed up on Twitter and I got the first tweet, so I'm gonna read it. Elliott screws up introduction, but economy good, per Schlossberg. That's it? Okay. Well, we'll try again. Facilitating our discussion with our two CFOs today is Samsita's President and CEO, Roseanne Faust. Well known and well respected in our communities, Roseanne is President and CEO of Samsita, which was founded in 1953 to promote business issues that enhance and sustain the economic prosperity of San Mateo County and the greater Bay region. In addition, she is past mayor and current council member in Redwood City. She holds a master's degree in public administration, bachelor's degree in international studies and economics, and has completed executive management training at UCLA and Stanford. How great is that? My two favorite schools. And I have it on authority that's Jim Hartnett's and Alan Beal's two favorite universities as well. She's the immediate past chair of the San Mateo County Transportation Authority and a current board trustee of the Bay Area Council Economic Institute, board member of the San Francisco Bay Restoration Authority, deputy chair of the Redwood City San Mateo County Chamber of Commerce, chair of Peninsula TV, and in her free time, she serves on several other boards of local nonprofits, and she tweets. So, for the past 3 years, Roseanne has been honored by the San Francisco Business Times as one of the most influential women in business in the Bay Area. Oh, we got a new tweet, Holly. Elliott still talking, everyone waiting for panel to begin. Okay, thank you. Please welcome Roseanne Faust.
Good morning, everyone. How are you? Our panelists are going to join us so then I can do the introduction. But I actually want to take the opportunity, one, to thank you all for being here today, to thank our sponsors, thank our table sponsors and our corporate sponsors, and I really want to thank my colleague, Amy Buckmaster, because this is what our county is about. It's about collaboration. It's about working together, and it's about doing programs like this that benefit every single person in the room. So thank you, Amy. So we have two great individuals here with us today, and I'm going to give you a little bit of their background, but when we get into the question and answer period, we're going to go back and forth between both of them, then we're going to have some time at the end for an opportunity for you to pose your questions. So our first panelist today is Kevin Beals, and Kevin is the current CFO of Nearbys, and I'm going to put Nearbys in quotes, and we'll get into why I do that later. Kevin has 15 years of experience working with multiple startups as well as a publicly traded company. He really is the innovation economy and what we are seeing in this area. He is a young professional. He gets it. I mean, he's probably been tweeting as we've been talking. And he will go over the CFO perspective from startup to publicly traded to a recent, very exciting happening that has taken place over the last few days. Our second panelist is Jim Burns, and he is the Executive Vice President and CFO of Silver Spring Networks. That is a Redwood City-based smart grid company. But Jim comes to Silver Spring with over 20-plus years of experience with Hewlett-Packard, one of the Valley's stalwart companies. Jim is all about how to take an enterprise and make it efficient, from all the different things that he had to do at HP to walking into Silver Spring post-IPO and dealing with a company that started very small and then moved forward. So our first question is to Jim. And I'm bringing out the iPad because I can make the type larger. So, Jim, please tell the audience about Silver Spring Network and focusing specifically on its relevance and importance to the people in the audience today. What makes your company interesting for these folks out there?
Sure, I will. Just real quickly, for those of you that aren't familiar with the company, what we do is we transform the power grid to a smart grid. So we're not a meter company, but we put our technology inside all of your meters so we can, and along all the way back up to the utility, so we can basically network homes and businesses to create a more reliable and efficient grid. So your question about why does it matter? I came to this company just a few months ago because I think the company matters a lot. It matters to the planet, you know, because what we do allows for lower carbon emissions, more efficient grids for the planet. It matters to the consumers. When our technology is deployed, there are fewer outages, and when there are outages, the restoration cycle actually happens a lot quicker. So that's really important for the economy. It's important for everyone to have power, and what we do actually lowers your power bill by making the utility more efficiency. And the third thing, and I think this community might, appreciate, is that it matters to the local economy. We employ over 500 people locally here in Redwood City. We've grown from a small startup and are now going global, and went public in March, and are growing nicely. We've had 3 quarters as a public company, and we've been growing double digits and exceeding our investor expectations.
Thank you. We're going to switch to Kevin. And Kevin, Nearbys had a really busy 10 days. When we spoke on the phone yesterday, I noticed that sleep is really a prime commodity for you at this point. Tell us about the recent acquisition that was just announced by Retail Next. So, and if you could tell what it means in regards to, and this is a word you're going to have to explain, omni-channel shopping experience. Does anyone in the audience know what an omni-channel shopping experience is?
No, you don't.
Okay, there's one person, and let's suffice it to say I'm not surprised.
She's lying too. Is this on? Okay, so basically what Rosanna was talking about, the startup, my last startup was, we founded 3.5 years ago. It's called Nearby Systems. We were acquired on last Wednesday, right before Thanksgiving, by a company called Retail Next. What Nearby Systems does and what Retail Next does is we provide e-commerce style analytics to brick and mortar retailers. So let me take a step back and kind of explain to you what's going on in the retail space over the last few years. The adoption of the iPhone and the iPad had brought mass disruption to the retail environment. So it used to be that people either shopped in the store or they shopped online. Well, now those lines have been blurred. People go into stores, they do what's called showrooming. You go into a Best Buy, you look at all the different TVs, you talk to the sales associates, you press all the buttons, you decide which one you like, you pull your phone out, you go onto Amazon, you scan the barcode on Amazon, you see that it's $200 cheaper on Amazon, you buy it on Amazon as you're walking out the store. Best Buy is freaked out about this, to say the least. Excuse me. Oh, shouldn't do that. Note to self, don't do that. The other aspect that online retailers have that brick and mortar retailers don't have is they're able to provide a much more personalized shopping experience with the shopper. I don't know if any of you go onto Amazon. I have 2 small boys. They love Legos and monster trucks. Every time I go onto Amazon, I have recommendations at the bottom of my page for Legos and monster trucks. I get emails from Amazon weekly about sales on Legos and monster trucks. They know all this information about me. I walk into Toys R Us. Toys R Us doesn't know who I am, what I do, what I have, if I have any kids, if they like anything. So brick and mortar retailers need to gather some of these online e-commerce style analytics that these e-commerce retailers have. So they're focusing on 2 things. They're focusing on making the shopping experience much more simple and easy for the shoppers, and getting a better identity of who these people are so that they can provide a better shopping experience. So what they are doing, one of the things that they're doing to provide a better shopping experience is they're providing free guest Wi-Fi in their stores. So you go into any Nordstrom, you go into any Target, a lot of these brick and mortar retailers, they have free Wi-Fi. So what Nearby does is we help these retailers that have free Wi-Fi to onboard customers. So you go into a store the first time, a landing page will pop up on your phone, says, "Welcome to Nordstrom. Here are the terms and conditions of use of the service." Click to accept, and you're on their guest Wi-Fi network. From there, we are able to give Nordstrom or whoever that retailer is a better detail as to what those shoppers are doing while they're in their stores. What search terms are they using? What websites are they going to? How long are they staying on a certain website? So are they being showroomed? Do they need to make sure that they are in line with what these other retailers are providing? If the search terms are for a certain product that they don't have, maybe they need to add that to their inventory. So we're able to provide those level of e-commerce style analytics to our customers. About a year ago, we signed a partnership with Retail Next. They're in the similar space, but they use video. So they're able to do a lot of things as far as people counting. So knowing how many people are coming in and out at different times so they can maximize their staff, knowing when they need to have more people or when they need to have less. They handle loss prevention. They handle path analysis, so they can know kind of the typical path that people go with in a store. So what end caps do you need where, and what works most, what works best. So being able to provide the level of that. About 6 months ago, they came and talked to us about merging the 2 companies. We were in the process of trying to raise a round at that time, so we kind of went dual efforts. And so we continued to work on raising a round and started talking to them, trying to figure out what synergies existed between the 2 companies. Obviously, we deal with a lot of the same companies, and but we do it differently, so there was some good synergies there. There was some management team issues that they had that we were easily able to fill with our team, and some technology that we were able to fill. So the merger was announced on Wednesday. Monday was my first day down at Retail Next, and I haven't seen my kids in 4 days because I leave before they wake up and I get home before they go to bed, or after they go to bed. So, but that's the life.
So it's interesting. I mean, that press release, and I have a copy of it here, went out 2 days ago on December 4th. As Kevin said, it closed last Wednesday, and we all know what last Thursday was, Thanksgiving, and he started the new job Monday. This is how quick things work. I have 2 questions relating to our panel for the audience so that they can get a flavor of you folks here. How many people have done exactly what Kevin described, being in a Best Buy or a Home Depot, checked on their phone, and made the purchase?
Yep.
Okay, that is, looking around, that's at least 60 to 70% of the room. How many go on to their electricity provider, whether it be PG&E or someone else, and check your usage? So from Jim's perspective in the smart grid, this is how we keep track. I mean, it's amazing how connected we are and how we're able to balance our experiences. And Jim's going to talk about going from a Redwood City-based startup. Silver Spring Networks 10 years ago was a small Redwood City-based startup. Today, 500 employees and a global network. Operations in, I believe, 33 countries. 33 countries. So can you tell us how that feels?
Well, the company started out and has been successful by being close to its customers and understanding what the needs are. Our first customer about 5 years ago was Florida Power and Light. Our second big customer was PG&E, which is locally here. In Florida, they've got hurricanes that come through all the time, and our technology, we had to put it in place so that they could withstand just massive weather patterns and thunderstorms and flooding and massive wind, and we were very successful when we did it. PG&E actually covers more real estate, 70,000 square miles of real estate than any other utility company in the country. So wherever there's a light bulb in Northern California, our technology is there, whether it's in a dense urban area like San Francisco or a more remote rural desert area with harsh weather patterns. So what's made us successful is listening to what our customer needs and adapting our technology. As we go global, and we're now in many countries, as you mentioned, we're in Southeast Asia, we're in Australia, we're in Europe, we're in Brazil. Brazil, we've been in for a few years. We're working with the biggest utility company. 30% of the grid the power off the grid actually gets stolen. So people actually climb up power lines and tap into them and wire it into their house. So our solutions, we're putting hardened steel enclosures in the top of power lines so that people can't do this, and they'll withstand gunshot and other things that people will do. So understanding the local environment, being close to your customers, what made this company successful in the past, and the needs are different in every country. That's what's going to make us successful in the future. Only about 10% of our business right now is international, but roughly half of our pipeline and the deals that we have are international now. So it's a good opportunity for us.
It's amazing. I mean, one, to think that people actually climb up on power poles themselves without any help, and just the countries that you are operating in and the pipeline that's coming up. I mean, that's amazing. As I said, as this room is happening this morning, what is happening outside these walls is directly related to the conversation we're having.
Yeah, the other thing I'll say is that, so we just won a deal last month in Copenhagen, which is considered the most sustainable city in the world, where we're not just connecting homes and business, we're actually networking their streetlights. So streetlights consume about 30 to 40% of a city's energy bill. And when you put an LED and you network them in there, you can dim them when you're not needed, you can flash them during emergency response, you can raise them, you can detect when they're out. So we're kind of moving beyond just the smart grid into the sort of smart city space too, which is pretty exciting.
Anyone in the room that is affiliated with local government should check out the Silver Spring website, because it talks about them moving into that smart city space. It's very, very interesting, and there are communities in San Mateo County that are doing that. So go on, it's silverspringnet.com. So that's where you can look at this information. Kevin, I alluded to this when I introduced you this morning in terms of your experience over the last 15 years in the different companies, the startups that you have started, that you've been a part of, and then the publicly traded company. Can you share with us some of the experiences you've had in that environment and between the private and public?
Sure. I think some of the most interesting things that I've realized over the years of doing this is how much technology has changed and how much easier it is to be an entrepreneur now than it was back when we first started our first company. So we started our first company in 1999. We raised a lot of money. All companies back in that time were raising a lot of money. So we weren't that special. But just to get the company started, to get it set up, we had to wire Cat5 cable throughout everywhere. We had to have an Exchange server so we can run our email. We had to have individual servers for each developer so that they could save their code base onto that. We had a huge server room, and so all that stuff costs a lot of money. To get a company off the ground was very expensive. When we started Nearby, we started on a shoestring budget. We put our own money in. We didn't raise any VC money to begin with. We had a very favorable rent from a very, very nice landlord who was very flexible with us as long as we were flexible moving from company to from space to space when he filled out those spaces. With Google Mail, we didn't need an Exchange server. We didn't need anything like that. We had wireless access points that we put up. We didn't need to wire anything. So we were able to move. We had, with Dropbox, we were able to save everything onto the cloud. We didn't need servers that people had to save their stuff to. With Amazon Cloud Service, our whole software solution that we run our solution as a SaaS. So for those that have ever heard of that, it's software as a service. We run our solution as a service. It all runs on Amazon. So it runs through their cloud network. Our customers feed all that data through the cloud up to Amazon. It's amazing what technology can do today and how much easier, how much cheaper it is to start companies nowadays than it was back when we first started. Like you said, I have had an opportunity to work at a public company. My second startup company was acquired by Aruba Networks, which was a public company. I'm a private company guy. I did my 2 years there that I had to do with my golden handcuffs, so to speak. But I like being part of smaller companies. I like being able to, if you see something wrong, you just get it fixed, as opposed to when I was at Aruba, it was like, okay, we need to set up a committee to decide that, and then you have to present your findings to the executive team, and then you have to, I could have gotten it done in a week. And so it's much easier. So I enjoy that environment better, which is why we've kind of gone back and continued to do that. But those are some of the things that I've noticed.
Is everyone getting just so excited about hearing this discussion? I mean, this is exciting, what Kevin talked about and the startups and everything that's happening. I mean, I don't know, I'm up here smiling because it is fascinating. And 2 months from now, we're going to have new information, and they're going to be telling us what the next horizon is for us. But Jim has started with Silver Spring in September. The IPO was in March. So you had 3 quarters under your belt and moving from a private venture-backed company to a public company. And Kevin said he used the term golden handcuffs versus golden handshake, which I think many of us are familiar with. So tell us, and you came from Hewlett-Packard. I mean, one, as we said earlier, the Valley stalwarts. So tell us about Silver Spring and kind of from a public, was a private company, is now a public company, and maybe touch on something that Kevin brought up about, is it difficult to get things done, and how is it dealing with investors?
Well, the big difference between a public and a private company is when you're a public company, your shareholders change every day. So we have about 600,000 shares that trade hands every single day. That doesn't happen when you're a private company. And when you're public, you have to provide the same level of information to the person that bought 5 shares of your stock and the person that bought 1 million shares of your stock. So there's some differences, I think, in terms of on the management team that mostly I see it changes the finance and legal departments a little bit in terms of how you run the business. So there are some changes. There's a lot of benefits to the employees to being public because they can get their incentives aligned with the company and have the ability to liquidate when they need to also. But for the most part, what most people in the company do hasn't changed from when they were private to when they're public. The engineers still come in every day building products. The salespeople still come in every day trying to sell more products and delight the customers, and same with the services people. So there are some differences, but generally, the mission doesn't change, right? The transparency might change a little bit. The need to attain quarterly performance and set investor expectations on a fairly regular basis and a very broad basis changes a little bit. So there are some differences, but I would say for vast majority of the people that come into work every day, other than the fact that they get to see how the stock performance is doing on their ticker, which I think is a good thing, because they when the stock goes up, everybody should feel good about things. Most people's job doesn't change that much. We're still on the same mission, trying to do what we set out to do 10 years ago.
Well, I'm going to open it up to questions shortly, and I have one last question, and it's for both of our panelists. And it's really to share with the audience those bits of wisdom that perhaps a mentor gave you each when you started your career, some learnings that would help from a leadership perspective, from an ability to get things done, whatever you'd like to touch on, but words of wisdom that would be interesting for the audience to hear. So, Kevin, would you like to start?
I don't think this is going to be revolutionary or anything, but I made a presentation about a year ago down at Santa Clara University about ethics and how important it is to be ethical nowadays, or it's always important to be ethical, but nowadays with everything with social media, with LinkedIn, with Facebook, with all the ways that anyone can find out anything about anyone in a couple of minutes, it's imperative that you constantly are being ethical and doing the right thing. So if you do something unethically, it's going to follow you, and people are always going to know, just because of the fact that people can always find out information about you, because the world is so LinkedIn, for lack of a better term, but it's so connected now that it's extremely important.
Who in the audience has a LinkedIn profile? Probably should ask the question, who doesn't? Who uses Facebook? Okay, who tweets? Pinterest? Anyone? Okay, all right, it's interesting to see. And I tried to go across the board with different, I think, age demographics and what people use. But Jim, share with us your thoughts, some wisdom.
I don't tweet. I'm older than he is, so, but my kids do. And I'm just happy with that one more thing to check. So for me, what I learned at a pretty formative part of my career is, a lot of people talk about strategy, but at the end of the day, what really comes down to is execution. And when you execute well as a business, nobody questions your strategy. When you don't execute well, everybody questions your strategy. And so execution is really is the most important thing. And the key to execution I've always found is having the right people and the right team on the right mission. And once you have that, things just happen magically. And so I've always was taught to put extra energy into recruiting the right people, making sure the team dynamics are right there. If you have a team dynamic which is poisonous, toxic, fix it immediately, or it will drag down your execution and you'll have big problems. So focus on the people and the execution for me.
So we're going to open it up now. Questions from the audience. We have a number. Start with Paul. And if you'd like to go to the microphone, that would be helpful, especially because we are filming for Penn TV.
Thank you, gentlemen, for coming and sharing. If any of you even look at the back of the program, you'll see the list of sponsors. And what's interesting is that this list probably doesn't change from year to year to year. And there's an absence of anybody from any high technology company participating as a sponsor. This leads me to the question that probably half the people in this room are involved with a nonprofit in some way or another. We have an extensive, very effective, very efficient group of organizations in the nonprofit area. They have not been successful in motivating the high-tech companies to participate in the community by supporting them in general. There's some exceptions, as always. My question to both of you is not to put you on the spot, but to say,
You get to answer this one.
what are we missing? How can we as a community get the high-tech people who are working 7/24 to participate in the community nonprofit field?
Paul, I appreciate the way that you phrase that at the end, because it's how can we collectively as a community do a better job of engaging our new innovative and high-tech companies. So I think we is the key, collectively is the other piece of that. So who would like to tackle? Okay, he hasn't slept in about 10 days, so we'll cut Kevin a little slack today.
All right, I've been hitting the caffeine too. It's a great question, and I think it's important for the tech community. I've spent most of my years at Hewlett-Packard, where we had a pretty substantial amount of local outreach, and you have the resources at a big company to do that. You have government affairs department, you have groups that more organized. When you're in a startup, rapidly growing technology company, you're working a lot, and but things change as you mature. We went public, for instance, in March. We set up our first foundation. We actually put money aside so that we could support local, some of our local communities. We actually just did our first awards. We had all the employees. We had nominations for where the money would go to, and every employee got a chance to have a vote on it. We had about 80% of the employees cast votes, which was great. So we set up a process to do that, but it's taken us a while to get there. We do a number of other things with local communities to support, but that's part of the maturing process. I think when you're a startup company and you've got 10 people there, and you're working around the clock, to a mid-sized company, to a large company, you've got different levels of resources to be able to do that. And I just think as you go through the maturity curve, your ability to do that. But I'm 100% behind it. And I believe it's a great opportunity, and I think that everybody should do it. And I actually think community outreach with the people and taking time out of your day to go help a nonprofit, or whether it's financially or just contributing, whether it's Second Harvest or other groups, it's a great team building activity. I do it typically every year. Take my team down to Second Harvest, and we just spend a morning and distribute food and go to lunch after. It's a great deal. So I think it's an important part for tech communities, but I also can appreciate the difficulty for some people to engage with them also.
I think Jim really said that rather clearly. Mike? Frank, I'm sorry, Frank and then Mike.
Oh, okay. Kevin, I want to congratulate you on the success that you've had, and I find it remarkable that you've overcome the obstacles of your parentage. So, but that being said, you talked about the profiling that's done by the retail community on somebody coming into a store. Is the line blurred on privacy? Where is it that my habits are going to be known to everyone?
Absolutely. I think privacy is a big concern in our space right now, and I appreciate you throwing me a softball, Frank. You had said you were not going to throw me any hard ones, and you bring up privacy. Thanks. Yeah. Yeah, I mean, we definitely we definitely deal with that. Our solution is a opt-in solution. So when you see the splash page that comes up, there are terms and conditions of use, and it says that we will be using your information for marketing purposes. There are companies in our space that are not an opt-in process, that are just tracking people and finding out what's going on. And there was a Wall Street Journal article that hit in June, and it was about a competitor of ours and Nordstrom. And Nordstrom is actually a customer of ours, but they were a pilot customer of this competitor of ours. And Nordstrom was not a good article, needless to say. And Nordstrom just basically flat out told us, don't come talk to us for 6 months, and we'll see what happens after that. So we definitely are feeling some issues on privacy, but we are trying to tread lightly and treat the. I think that there's sensitivity right now, but it's the same sensitivity that people were facing initially when e-commerce came out. No one wanted to put their credit card down anywhere. They were all afraid to do that. If any of you actually knew what e-commerce websites actually know about everyone, you would have no issues with the type of information that we're able to gather on people that are actually in brick and mortar stores. So I think the sensitivity level has kind of gone down on the e-commerce side. It's up right now on the brick and mortar side. But I think as long as we can prove that we're providing a better shopping experience for the end user, that at the end of the day they will be okay with the invasion of privacy, so to speak.
I'm going to have Mike come up, and in the meantime, with the show of hands, who has not ever bought anything online?
Yeah.
Okay. Then you must all be shopping local, so all the tax money
That's
stays
my
here.
dad, too.
That works.
I think I must have been adopted.
Okay, well, that is a good. Okay. So
Yes,
we
you
have
do.
balances here. Mike.
Good morning, and thank you both for being here. We started the day talking about the national economy a little bit out in California and some of the greater macro risks. I'd be curious to hear from you, what are the biggest concerns you have as you grow here in San Mateo County in the Bay Area?
I think one of the biggest risks that my company has from the report earlier was really what the retail market is looking like. So our customers are retailers. So the spend that they do on our technology is somewhat discretionary. So there is an ROI that we can prove for these customers, for our retailers, and make it help them make more money based on what we're able to do for them. But that's certainly something that we are always looking at on a micro or macroeconomic standpoint. So please, everyone, go shopping. Go to your brick and mortar stores, not just Danny. Go and buy things.
Yeah, we look at the global economy when we go into certain countries to see their ability to actually follow through on pilots, because we'll start off with maybe piloting with 50 or 100,000 homes for the utility that might have 4 or 5 million homes, and we're hoping that the economic conditions and the financing conditions are there so that they can do the big deployment, or we don't make any money on it. So we do look at the kind of the global economy when we go into a certain market, but we also look at the local economy for employment here too. Employing people in the Bay Area has its pros and its cons. You know, people don't stay as long as they do when you employ them in other parts, and yet there's some incredibly skilled people in the valley here too. And so we look at that also relative to how do we retain our engineering talent when you've got hundreds of other companies around here that are all waving different levels of goodies in front of people too, which is a challenge for everybody from an employment standpoint. So we're trying to make sure we got the right secret for success in terms of how we operate here in the Bay Area too.
Do we have time for a few more? One more question. Clem, I know you've been standing back there, and maybe if Clem's is brief, we can have Mike Moran, if that's all right.
Jim, Kevin mentioned the difficulty of balancing family and career. You've been through it. Do you have any tips for the younger people in the audience with that challenge?
Well, I'm not a role model for work-life balance, just to put a disclaimer out there. I did have and I do have a daughter that has special needs. And so, keeping the things that are important to you, don't compromise those. Get to the doctor appointments and the key things, and just don't compromise on the things that are important to you is my point. People that you work with are people too, and they understand.
I would also say from my experiences, it's been great that I've been able to work with a lot of my friends. So I don't have to worry about seeing them outside of office hours because I see them during the office. So I can spend all my non-work hours solely with my family, and I don't feel like I'm disregarding my friends.
Thank you. Mike, you're the final question. So in other words, it needs to be really good.
Well, thank you. No pressure. Well, thank you, gentlemen, both for being here today and for having your companies in Redwood City and on the peninsula. So from a commercial real estate perspective, tell us a little bit about why you've chosen to be in Redwood City or on the peninsula, what keeps you here, and then if you could, for just 2 seconds, what can we do as a community, both from a government perspective and residents and employers, what can we do to both retain companies like yours and recruit more to be on the peninsula?
My landlord's sitting over there, so I'll have to be thoughtful with the answer here. You know, I mentioned about sort of the specialness and the challenges of operating in the Bay Area, which evolve and change. This is an economy that sees more feast and famine than some other economies just based on the technology cycle curves. Retention of people is key, so being in an area that's got good access to public transportation is big. We're close to the train station. We get a lot of people that actually take the train and have a shuttle service. And if we didn't have that shuttle service, we wouldn't be able to attract people from San Francisco and Gilroy and others that are nearby here. So we look at things like public transportation, which is important. Particularly, I don't know, have you all noticed, but it seems like the highways are as congested as I've seen them in a long, long time through here, and so physical locality is important and close to public transportation. As far as and then, you know, the talent, I think if you've got the transportation, you can get the talent from pretty much anywhere in the Bay Area. You know, it's when you're not closer to public transportation, it's harder. You're seeing more companies like Apple and others, they're actually chartering their own buses to bring people in from different areas because they can get the carpool lanes, they can do work on it. So for me, you know, transportation is a really big deal because it has a dramatic effect on our ability to source the kind of talent that we need. And it's a big deal for the people that are, because it's a substantial portion of their day is for some people how they commute. So that's a big deal for us. And then providing the right facilities and the right kind of local environment is important too.
Yeah, I don't really think I have much more to answer besides that. I think getting engineers is the hardest thing that any startup has to do. And it seems like the majority of engineers are in San Francisco. So being able to provide some sort of, you know, a lot of our guys do take the train. I always requested in any of our spaces that we had a shower. So that's always important from a commercial real estate standpoint, to have a shower in there so our employees can shower after they get in so they don't stink all day. And you know, having nice areas to go around during the day for lunch and you know, breaks, those are definite pluses that we look for.
Let's thank Jim and Kevin.
We're going to wrap up now. Roseanne, thank you very much for leading our panel. Jim and Kevin, thank you. And thanks to Oracle again for your hospitality. I'm just going to read the last couple tweets that Holly sent out. Don't forget the Progress Seminar, April 11th through 13th at the Hyatt Regency Monterey, coming up in 2014. Next tweet is Sam Cetus 2014 Awards of Excellence, Thursday, March 27th here at the Oracle Conference Center. And final tweet, I'm not going to read that one. You'll have to check hashtag EO14 if you want to see the last tweet. Have a good morning. Thank you very much for coming, and drive safely.